You already hold crypto. You already believe in where this is going. You have survived at least one bear market, watched your portfolio bleed, held anyway, and told yourself the thesis is still intact. And yet, right now, if you are being completely honest with yourself, your stack is not growing the way you thought it would by this point. You are not losing, but you are not winning either. You are just kind of there, holding, watching, waiting for the market to do something that turns your position into the life-changing number you got into this space for in the first place. Here is what nobody is going to tell you. The market is not the problem. The size of your position is not the only problem either. The problem is that you are playing crypto like a retail investor, while whales play it like an operator. And until you understand the difference between those two mindsets at a fundamental level, it does not matter how good your coin picks are. You will keep getting shaken out, undersized, and outmaneuvered by people who are not smarter than you, but who are playing an entirely different game with an entirely different set of rules. This video is about those rules. All of them, the ones nobody posts about because sharing them would reduce the edge they create. Let us get into it. The first thing you need to understand about whales is that they did not become whales by finding better coins than you. The crypto space is full of people who picked the right coins and still did not build real wealth. They found Bitcoin early and sold at $500. They found Ethereum before the DeFi explosion and traded out at $50. They found XRP, held it through the SEC lawsuit, watched it hit $3.65 in 2025, and then watched it pull back 60% and questioned whether the thesis was ever real. Right coin, wrong behavior around it, and behavior is everything. Whales are not oracles, they are architects. They build positions with intention, they manage those positions with discipline, and they make decisions based on a framework that has nothing to do with what's trending on social media today. The retail investor reacts, the whale executes a plan, and the plan was written when the market was quiet, not when it was screaming. So let's talk about what that plan actually looks like, because this is where most intermediate holders fall apart. They have conviction, but no structure. They believe in their assets, but they have no written strategy for accumulation, no rules for position sizing, no predetermined response to volatility, and no defined outcome they are actually building toward. They are hoping the market turns their belief into wealth. Whales are engineering that outcome regardless of what the market does in any given week. The first pillar of whale-level thinking is position architecture, not just buying more, structuring how you buy. Every whale has a core position and a tactical position. The core position is the stack they are not touching under any circumstance short of a fundamental change in the thesis. This is the position they sized when conviction was highest, and conviction was based on research, not price action. It sits in cold storage or institutional custody. It does not get checked daily. It does not get traded against short-term moves. It is untouchable by design, because the single most wealth-destroying behavior in crypto is selling your core position during a bear market and then buying back higher during the next bull run, which is exactly what retail investors do, every single cycle, without exception. The tactical position is different. This is the portion of their allocation they use actively, dollar cost averaging into dips, taking partial profits at predetermined resistance levels, redeploying capital from assets showing weakness into assets showing structural strength. The tactical position is what keeps them engaged with the market without ever threatening the core. If you do not have this separation built into how you manage your crypto right now, you are one bad week away from making a decision that costs you years of progress. The second pillar is understanding what volatility actually is in the context of building wealth. Retail investors experience volatility as threat, as evidence that something is wrong, as a signal to reconsider their position or reduce their exposure. Whales experience volatility as the mechanism through which they accumulate more at lower prices from people who cannot emotionally tolerate the discomfort of a drawdown. Every time the market drops 30, 40, 50% and retail investors sell in panic, someone is on the other side of that trade, buying everything they are selling. That someone is not a market maker running an algorithm. That is a whale with a plan, a cash reserve, and the emotional discipline to act decisively when everyone else is paralyzed by fear. That's not talent, that's preparation. The third pillar is the one that separates serious wealth builders from everybody else. It's called asymmetric positioning, and it's the core reason why whale portfolios grow faster than retail portfolios, even when they're holding the same assets. Asymmetric positioning means you are not treating every asset in your portfolio the same way. You are sizing positions based on your conviction level, the asset's risk profile, and the distance between current price and what you believe fair value to be based on real fundamentals. A whale does not put the same amount of capital into a proven blue-chip asset with a decade of track record as they put into a newer asset with higher upside potential but less certainty. They weight their portfolio intentionally. Larger allocation to higher certainty, smaller allocation to higher asymmetry. And they define in advance how much they are willing to lose on the asymmetric bets before they are proven right, because some of them will not be proven right, and that is part of the model. Retail investors do the opposite. They put tiny amounts into everything because they are afraid of being wrong. They call it diversification. What it actually is a portfolio architecture that guarantees mediocre returns even when their thesis is correct. If you put 2% of your capital into an asset that goes 10 times, you made a 20% gain on your total portfolio. Life did not change. But if you put 15% of that same asset based on deep research and genuine conviction, that 10 times move changes your entire financial situation. Sizing is the strategy, not just what you buy, but how much you are willing to stand behind it. Now, here's the part of this conversation that most crypto content completely avoids, and it's the most practical thing in this entire video. Whales think about their crypto holdings in relation to their full financial picture. They do not treat their crypto stack as a standalone lottery ticket that either pays off or doesn't. They are building a full wealth architecture designed to generate, preserve, and compound wealth across multiple asset classes and time horizons. What does that mean practically for you right now? It means that the single most powerful thing most intermediate crypto holders can do to accelerate their journey toward whale status has nothing to do with finding a better coin. It is generating more capital to deploy. Income, active income, business income, side income, any income that is not derived from your existing portfolio. Because here's the math that nobody wants to say out loud. If you have $5,000 in crypto right now and that 10x's, you have $50,000. Meaningful, but not life-changing in most people's financial reality. If you have $50,000 in crypto and that 10x's, you have $500,000. Now we're having a different conversation. The gap between those two outcomes is not about which coin you picked. It's about how much capital you brought to the table before the move happened. Whales did not start as whales. They became whales because they were relentlessly focused on increasing the capital they had available to deploy into high-conviction positions during high-opportunity environments. They treated income generation and capital accumulation as a full-time project that ran in parallel to their investment strategy, not instead of it, in addition to it.
The fourth pillar is information asymmetry, and this one is subtle but critical. Whales are not working off the same information you are, not because they have access to insider information, at least not in the legal sense, but because they have built systems for processing publicly available information faster and more accurately than retail investors who are getting their analysis secondhand from YouTube thumbnails and social media posts that are already 3 days old by the time they appear in your feed. The whale's information advantage comes from reading primary sources, actual on-chain data, real network metrics, official regulatory filings, earnings reports from publicly listed companies with crypto exposure, technical documentation from blockchain projects, government policy papers on digital asset frameworks. Not summaries, not takes, the actual documents. This takes time. It takes intellectual discipline, and it creates a genuine edge because most retail investors will never do it. When you read the actual Federal Reserve policy document on ISO 2022 migration timing and understand what it means for settlement infrastructure, you are operating with information that the person reading a summarized tweet about it simply does not have. That gap is where edge lives, and edge, compounded over time, is how portfolios get to whale size. The fifth pillar is patience with a deadline. This sounds like a contradiction until you understand what it means. Whales are patient with their positions in the sense that they do not react to short-term price movement or market sentiment, but they are not passively waiting forever. They have defined time horizons. They have defined thesis checkpoints. They have specific events or developments they are watching for as confirmation that their investment thesis is playing out as expected. And if those checkpoints are not met within a reasonable time frame, they reassess. Not because the price went down, because the thesis changed or failed to develop. This is how you hold through a bear market with conviction rather than delusion. You do not just hold because you are emotionally attached to the asset. You hold because specific things are happening that confirm the thesis is intact. New partnerships being announced, regulatory clarity advancing, network activity growing, institutional custody expanding, on-chain accumulation by sophisticated addresses continuing. These are thesis confirmation signals. If they are present, you hold and you accumulate. If they go absent for an extended period, you are no longer holding on the basis of a thesis. You are holding on the basis of hope, and hope is not a strategy. Here is how all 5 pillars connect into a single operating system for building wealth in crypto at whale speed. You build a core position in your highest conviction assets based on deep primary research. You separate that position from your tactical capital and you make it psychologically untouchable. You maintain a cash reserve specifically for volatility deployment. You size your positions asymmetrically based on conviction and risk-adjusted upside rather than spreading thin across everything. You work in parallel on increasing the total capital available to you through income generation, not just portfolio appreciation. You consume primary information rather than second-hand takes, and you define your thesis checkpoints clearly in writing so you know the difference between patient holding and hopeful delusion at any given moment. This is not a complicated system. It is not a secret. Whales are not running some mystical playbook that you could never access. They are simply executing these principles consistently, without exception, through market cycles that make retail investors abandon their strategies and act on emotion. Consistency is the compounding mechanism, not genius, not luck, not being first into some obscure coin before anyone else found it. Showing up with the same disciplined framework every single week, regardless of what the market is doing. You already have the most important thing. You have conviction. You believe in where this technology is going. You have survived enough market cycles to know that volatility is not the end of the story. Now you need the operating system that turns that conviction into actual compounding, life-changing wealth. And now you have it. If this video reframed how you think about building wealth in crypto rather than just holding and hoping, hit that like button right now. It tells me directly that this kind of structural, framework-based content is what this audience needs more of, and it keeps me building videos like this instead of churning out price predictions that age badly in 48 hours. Subscribe if you want the kind of analysis that treats you like someone serious about building real wealth, not just someone looking for the next pump to ride. Now, here's your comment question, and I want a real answer. What is the single biggest thing that has been holding your portfolio back from growing the way you know it should? Is it position size, emotional selling during dips, not enough capital to deploy, or something else entirely that this video did not cover? Drop it below. Your answer shapes what I make next. And if you know someone who holds crypto, believes in it completely, but can't figure out why their stack isn't growing, send them this video right now, because the answer is in here, and the sooner they see it, the sooner the compounding starts. Do the work, build the system. The whale status is not a destination, it's a discipline.